welcome to the Monday Futures Market Outlook for August 7, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out our eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar and look at the index futures, and we're looking how the U.S. dollar has been behaving in the last little while. The weakness that came in over the last few days has really been dramatic, and now allowing the dollar index to work its way right down towards that 81.50 to 82 focal point down below, where a lot of the key bottoms occurred in June. This is a material reversal, not that there's an imminent decline in the U.S. dollar, but rather that it neutralizes a lot of the upside potential that it had even just a week ago. At this stage, this means that the U.S. dollar is much more likely to be stuck behaving in a far more range-bound manner in the upcoming month. And so it's likely that the support line here will likely hold, but it's likely that any subsequent rally will probably only muster up enough strength to get it back up towards some of those highs around 83.50 or so on the upside. That brings us to wanting to talk about the Euro FX futures here. And the Euro has been one of the places where the resounding strength has been coming that has caused that U.S. dollar to weaken. And the Euro was substantially oversold, and it is now bouncing off of those levels. This is going to be a crucial level right here at this 125 to 126 and change kind of area, because if this is nothing but just a short-term flagging formation that's developing off of a very oversold state, then this overhead resistance should be stalling the price action of the euro up at these levels, and what inevitably that may lead to a correction that goes in double bottoms along the downside in the upcoming months. Really, at this stage, the only way that we could become far more short-term bullish the euro would be if there was some material price action that substantially improved the landscape in the euro area. If we saw the euro substantially increase to the 127 to 128 area during a rally, and then subsequently contain all selling to around the 125 area, then that would change the landscape from which the euro is trading, and then we'd have to consider a whole bunch of alternate intermarket scenarios that we would have to develop. Next year, we'll take a look at that 30-year Treasury bond, and the Treasury bonds have made a material reversal in the interim. We've seen the Treasury bonds come off of their highs now that they attempted to break to a higher high above that 53 level and just simply couldn't hold it. At this juncture, this correction is likely to come all the way down towards this 147, 148 level, where all the consolidation lows occurred in the months of June and July. At that juncture, we're going to get critical piece of information as to what's in store for Treasury bonds, the way that they trade in the upcoming cycle, and particularly the way the currencies confirm it, will have a direct impact onto the way that the stock market will behave in the upcoming months. Next year, I want to take a look at copper futures, and copper made a direct test of what is now the 325, 330 focal point, where all the lows came in, also in the month of June. Really, at this stage, we have copper still relatively weak, even though it has impressively reversed it in the last few days. It still has not done anything that technically implies a bullish scenario, but we will be watching if the price action strengthens here. There's always a chance we could still get a burst up towards the highs around 350, if not a test even of 360, 365 on the upside. We'll be watching whether or not copper here can gain any momentum off that. Next year, I want to take a look at crude oil, and crude has also had a nice reversal day the last week that allowed it to potentially break out. We're going to be watching crude as it trades up into these zones. Not only could it reject here off a double top, but there are a lot of overhead resistance levels that target the 95 to 97 level on the upside, and that really is something that we're going to be watching for overhead resistance in the upcoming cycle. And Nonetheless, right now in the short term, there is room for crude oil to strengthen, but we'll be watching to see when and how it follows through and where that overhead resistance develops over the next couple of weeks. Next year, we're going to take a look at gold futures, and we can see gold is actually holding up relatively well. While we've had a number of scenarios where we anticipated gold to potentially weaken in this environment where the U.S. dollar is weak and a lot of the global marketplaces are risk on, gold is finding a bid here. We would need to see a material break to higher highs in order for us to really start contemplating a number of bullish scenarios, but clearly gold is behaving relatively well in this range-bound environment. That brings us to wanting to look at the weekly charts of the S&P 500, and what we have here is an 80-week moving average that has depicted the bull and bear market cycles the market has gone through. When we tested this earlier this year, we made a direct test of that 80-week moving average and subsequently found that support. That continues to support the idea that the primary uptrend here is in place on the markets. That we would need to see a material breakdown below the 1300 level in order for these markets to become bigger picture bearish. So when we take a look at those the daily chart of the S&P 500, you can see that we had a overall thesis that we was looking for there to be a rising wedge that would break down off of what was a double top earlier in July along the upside. When that 1320 support line held, the market materially improved on the upside and has broken now to higher highs and has held it. Really at this juncture, a full retest now of that 1400 to 1420 level is obviously occurring, as we literally are at the 1400 level as we speak. At this juncture, the likelihood of a material correction occurring right now is not imminent. At this stage, we'll likely see the S&P 500 bang out some key overhead resistance levels that could take multiple weeks along the upside before there is likely a decline, and that at this juncture appears to be now pushing more and more likely to the September-October window. Overall, if the market was to, let's say, hit 1420, there's even a measurement that suggests we could even go as high as 1430, 1440 on the upside, and that would even exceed those highs. It would, at this point, as we approach these upper zones, it's becoming increasingly likely that the lowest point that we traded in the month of May and June is likely to be the low point of the market, or at least increasingly likely, and that any subsequent market correction that ensues, even though we will inevitably get one, may not exceed those previous lows. If we reject exactly after double top, it could be far more range bound, that we exactly trade right to the bottom end of the range and stay sideways. But if we break to a higher high before the correction ensues, then we may end up getting nothing but a full Fibonacci retracement back to 1320 to 1340 off of those highs, like a 100 S&P point correction off of that zone, and then subsequently, and that would be the correction that would occur in that September-October cycle. Nonetheless, a lot of those really bearish scenarios we had, and the market is at least neutralizing those perspectives at this point. And but nonetheless, it doesn't change the fact that the S&P represents a pretty poor risk-reward proposition up here, and we would need some sort of a correction to accumulate longer term stances in the market. When taking a look at our key intermarket observations, we remain now on the short term neutral. So many of these stances are long-term stances that we've had all year. In many cases, a lot of them are actually being neutralized as well. In fact, it may be a little too early to suggest commodities and bonds and global stocks have officially reversed their trends, but there may become increasingly amount of evidence in the upcoming months that may force our long-term stances to be far more neutral, and then our short-term stances will adjust for where the opportunity lays. nonetheless, at this point, we are not seeing any immediate trends that are likely to ensue beyond further consolidations off of these levels, and then we'll change our stances accordingly. That was your Monday Futures Market Outlook. Thank you for joining me.